Welcome back to the Fostering Financial Victories podcast. My name is Eric. I'm your co-host with Bri Prosser, and we are joined today by Jonathan McAdams. So kind of a timely discussion, something we booked really about 4 months ago, put on the calendar, had no idea what would be going on in the world when we did that. So it feels like it needs to be one of those, hey, we interrupt your regularly scheduled plan. But Jonathan, thanks for taking time out of your day. I know you got a lot bouncing around. The goal of today is really to kind of talk through what's going on in the market. Originally, we had planned to go through more of like a halfway point of the year and update things. I think most people probably want to know, all right, what's going to happen today or tomorrow, or what did happen yesterday? So again, thanks for taking some time.
My pleasure.
So where do you want to start? Yesterday was a fun, interesting day to watch take place. The day before was a little bit better. So it's like, where do you think we should kick this off at?
Yeah, no, I think it's endemic of the market we've been in, which is a volatile market, because whenever there's uncertainty in the environment, in the economy, in companies, the market's going to move quite a bit. It can move up big one day and down big one day because we're in an information vacuum, a little bit of people trying to grapple with what's next. So seeing these big moves is not unusual, particularly in market pullbacks. You're going to see that higher volatility. That's just kind of par for the course. So I wouldn't put any too much stock in any kind of one-day move. I think what you did see yesterday is endemic of kind of what we're seeing, kind of broadly speaking, in the sense of you had the day before you had Walmart come out and lower guidance, and then you had Target that morning come out and do the same. Both stocks were down double digits by quite a bit. And what they're saying is, look, we've got, we don't have a demand problem. We've got people coming in the store. Our revenues are fine, but we're having trouble managing our costs, right? We've got high inflation. We had, energy costs and shipping costs and everything kind of surprise us, quickly during the quarter. And so we've got to adjust and try to manage those costs, but we need to take down our earnings numbers. And so the stocks come in. And I think that's a microcosm, I think, of what's happening in the market, which is, corporate-wide, company-wide, firm-wide, economy-wide, how much is inflation biting into profit margins, and potentially ultimately demand. We don't know the demand side yet, because so far what we're hearing is demand is fine, or relatively fine, right? Airlines came out this quarter and said, we've got record bookings. Cisco came out today. It's down double digits. And they said, we've got record orders. Our demand is fine. We can't get the supplies and the chips and the everything else. And so our margins are going to compress and we got to lower our guidance. So that's what you're seeing in the company. And so the market's trying to wrestle with what's the right earnings number based on all of these inflation and interest rates and demand factors.
So what do you think the biggest elephant in the room is likely going to be? Is it inflation? Is it interest rates? Is it earnings? Like, if you had to look at one thing to focus on, and maybe that's not fair to say, but what do you think the biggest one that we should be thinking about?
Yeah, I think in a sense, they're all kind of interrelated. So I wouldn't say, I don't think you can take any one in isolation, right? Because interest rates are tied to what inflation is doing, right? And then both of those tie into what ultimately earnings. So they're kind of interconnected. But I would say the one thing, everyone's, on everyone's mind, and probably the leading indicator is going to be inflation.
Okay.
That's what, that's what's driving these higher costs for companies. That's what's forcing the Fed to respond like they are, which is raising rates. They want to get inflation under control. And they're the only tool they have to do that is with interest rates. And so you are seeing inflation, move to 40-year highs. That's not a surprise to anyone at this point. Beginning of the year, yes. But you are starting to see, so that's what we're watching closely. You are, some analysts, and I would argue, we may be getting close to peak inflation, meaning we've seen some of the highs. The last report, both in consumer prices and producer prices, have come off the boil a little bit. Too soon to say whether, we're headed back down. And if you look at things like commodity prices and some of those things, they've all peaked kind of earlier in the year and they've come off a little bit, from their highs. And so you think about inflation. Inflation is just what's the change in price year over year, right? So unless prices keep going higher, if they level out or even come in, eventually you're going to get inflation to roll over. So So that's what everyone's watching. That's what the Fed is watching. And that's going to determine the pace that the Fed goes based on how sticky that inflation is. So, I would say we're not out of the woods. I think inflation may be stickier for a while just because so much of it is supply related, meaning we have lockdowns in China, which is gumming up the supply chain. We have, just we have backlogs in chips and everything else. Some of it COVID related, some of it just higher demand. But that's going to take longer to fix. And so inflation may be more elevated for a while. But the nice thing, like I said, the more volatile end of that, the commodity end of that, which is more subject to kind of real-time pricing, you're starting to see some relief in pressure. It's not, we're not going back to the lows, but it's come off the boil a little bit.
So you mentioned a lot in that with the Fed, with what they've been doing and talking about with interest rates. They've seemed to change their tune a good bit over the last 2 or 3 months. What do you feel like they're going to stick with?
Yeah, you've seen the Fed had to pivot pretty hard, right? They've gone from, kind of end of last year to saying, yeah, we're seeing higher inflation, but it's transitory, right? They kept using that transitory word, meaning, yeah, we got a little short-term spike because demand is high and we've got some COVID, and so now they've quote unquote gotten religion and said, okay, inflation is much stronger and higher than we thought, so we are going to fight it. And so he's been very straightforward in saying we are going to raise rates until we see inflation go down, right? And I think people overanalyze the Fed. The Fed analysis is fairly easy. They have 2 mandates, right? They have stable employment and stable prices. Right now we have very, very tight employment markets. Whether you look at job openings, wages going up. So, almost maybe to the point of being too tight. We just people can't find workers. It's just a very difficult labor market, but it's very tight. Unemployment is very low. So they're not concerned with that part, right? And the one part of their mandate, they're saying we're good. We're actually maybe even need to, untighten it a little bit. So their other mandate is, okay, inflation. So they're going to put the pedal down until they can get the inflation numbers down. At some point, if inflation comes in and we start to see, unemployment go higher, whether it's a slowdown in the economy, there will be a tipping point at some point where they'll say, okay, we're gonna take the foot off the pedal a little bit. But right now we're not at that point. But I think there's potential for that down the road. If inflation can kind of come in a little bit, maybe we start to see a tick up in some of the initial unemployment claims, or some of the unemployment figures start to tick up a little bit. They may say, okay, maybe we'll take a little more balanced approach.
Okay. So you may also mention China. Okay. With China being essentially shut down out of the trade market for the last, 4 weeks, 5 weeks? Seems like that's starting to ease off.
We're getting mixed signals. Yeah, I think, depending on news reports you read, we'll get a report that says, yeah, China's going to, so it all boils down to that, China still has their zero COVID policy, right? And so they will shut down large portions of cities, entire cities, with just a small outbreak. And so until we get, official word that that's going to be relaxed, but again, we're getting mixed stories. We'll get saying, okay, China's, he'll come out and give a speech and say, no, we're sticking to the zero COVID policy. And then you'll get a story that comes out and says, oh, they may relax, coming out in the future, but it'll be citing some unnamed source, So it's hard to know really what's kind of the future there, because it's China after all. So it's a little bit hard to get a good read, but yes, that is, I think that's an underreported kind of piece to the puzzle, or piece to the economy, whether or not we can kind of unclog some of those supply chains in China. In the meantime, we're still, I think, backing up a little bit, I think we had years and years of kind of offshoring to China and elsewhere, but largely to China. I think people are now saying, yes, that was good for my bottom line, and it's great when things run smooth, but when you get bottlenecks and you've got all your supply coming out of China, Cisco can tell you that, today, maybe we need to diversify and look other places. But that process takes time, right? That doesn't happen in 3 months.
So I didn't date this when we first started, but it is May the 19th. So that just so if you're curious as to what timing we're talking about here. So Jonathan, we were talking earlier about kind of what the market has done from January. So I just took a snapshot of year-to-date numbers, and some of these really stood out. So from a sector standpoint, best sector and then the worst performing sector in the market, the best one's actually up 48%.
Energy.
Yeah.
Mm-hmm.
Yeah.
Yeah.
And then the worst one's down 30%, which was a consumer discretionary. So what are that's such a massive swing between the two. Can you talk to that a little bit?
Yeah. And I think it's reflective of what we've already been talking about, right? So energy companies had been shunned for 10 plus years. Oil prices went negative during the pandemic. You had a lot of, with the rise of ESG investing, you've had a lot of large pools of capital shun energy companies kind of, en masse. And so it was kind of an unloved sector. And then all of a sudden, and so through that, being unloved, they didn't invest capital into searching for new oil or new commodities, et cetera, et cetera. So it's been an underinvested sector. All of a sudden, you've got a big spurt of demand through, with the stimulus that came through in 2020 and a recovery from COVID, and you've got low supply. So now you've got prices. So oil has moved from negative 40, a couple of years ago to now, 100 plus. That's good for energy companies. So and you've got, you've had a capital base that has shunned them for years, and that takes time for them to kind of come around and say, oh, maybe I need some energy in my portfolio. I think at one point, energy used to be, close to 15% of the S&P 500. Now it's less than 3. It may be back over 3, but it, got to like 2.5 or high 2s. So it was increasingly became just a marginal piece of the S&P. So people were underinvested. And so now people are putting capital there. So, but anytime you've got, in this inflationary environment and you've got the market shifting from kind of a growth mindset, technology, growth at any price, which was working, now you've got higher interest rates, higher inflation, some of those value sectors, and energy falls in that sector, is going to be better. And on the other end, consumer discretionary.
So what does that mean?
What's that?
What is it like? Give them an example of what consumer discretionary might be.
So that could be, we talked about Target to some extent, or it could be airlines. It could be, so it's any sector where it's subject to consumers' kind of discretionary spending. So there's another sector called consumer staples, which are more things that people need. So grocery stores, food, some of those things that people are going to buy regardless. They may not buy brands, but maybe they buy the cheaper version. But you still need food and power and everything else to live. Discretionary are the things that you may not need that you could maybe push off for a year or two, depending on when things happen. So it's more discretionary purchases. So that makes sense, right? In this environment where we're fearing recession, right? That's kind of the big fear. We head into a recession. Those stocks are going to get hit the worst because those dollars are the first to get cut, when people are feeling tight in their budgets.
So, all right, people are going to stop spending money on things that they don't necessarily have to have, right? From that discretionary side.
Right. We're not seeing it yet, but I think that's the fear in the market, right?
Okay.
Yeah.
So the big six that has kind of taken the market by the hand and drug it along for the last couple of years because of the size of these companies. Can you talk to what they're seeing?
Yeah, I think, it's been a mixed bag. So I think in a sense, they all kind of traded as a monolith during the COVID, pre-COVID and through COVID. They all kind of had a nice tailwind behind them. You've seen some bifurcation in some of the results. So they're still seeing healthy growth and demand, but now they're becoming a little bit more story specific. So you can't lump Facebook in with Microsoft, and you can't lump Apple in with Google, because they all have a little bit different dynamics. So you've seen some bifurcation in those results, where Microsoft, even and Apple have held up fairly well. Facebook's had struggles. So you're starting to see that. And I think broadly speaking, those large tech names became, a very large percentage of the S&P, and frankly got to valuations that were, fairly historically very rich. and the environment turned on them, right? So we went from a low interest rate, maybe not disinflation, or maybe not deflation, but disinflation, right? Low inflation environment, low interest rates, high growth in earnings, valuations expanding. So that was good for those types of stocks. That environment has flipped on its head, right? We're in an inflationary, higher interest rates, value is working. So cheaper stocks are working, things with, and those become out of favor. Those are natural cycles, right? Those ebb and flow over the years. Growth versus value is a kind of an age old. Those companies are still doing well. They still dominate their markets. They're still growing, but the market's trying to find what's the right multiple to pay. And so they're giving Apple a higher multiple than Facebook right now. Facebook is extremely cheap when you look at it either on free cash flow or earnings. They're working through some issues, but you can get Facebook for under right around 15 times earnings, where I'm still having to pay over 30 for Apple, or maybe high 20s for Apple now.
And Facebook was where before we started to see a pullback
in terms of multiple?
Yeah,
probably it was probably in the low to mid 20s, at its peak.
Okay.
Yeah.
So do you think that the growth sector, given the way it's kind of gotten beat up, is primed to bounce, or are we ready to say, yeah, let's go buy that sector now, or is what do you think?
Yeah, I think there's some good values in the space. Certainly anytime you get this magnitude of pullback, if you look at the Nasdaq, we talked about some of those pullback numbers. The Nasdaq's pulled back 27, which almost matches what it did in COVID during COVID shutdown. So it's almost matched what it did in COVID. So you've had a very sizable pullback. I will say this, though, you started at a very high valuation level. So there still could be some adjustments there. There are specific stocks, I think, within the sector that are starting to look very, Facebook's one, and that I mentioned, that looks very cheap to us on a go-forward basis, whereas some, still need to come down. You've seen, what you've seen, yes, we're in a tough market, but we've been in a bear market for some of those, high growth, lose money now, make money later type story stocks, the COVID beneficiaries, the high growth software companies. I mean, you've seen a massive round trip and bear market in those for over a year now. So the DocuSigns of the world, the Zooms, some of the Snowflakes, some of these high growth companies, you've come from massively overvalued to maybe now just overly to fairly valued. So where the bottom is, I don't know, but some of those may at some point start to get really interesting. So yeah, I think there's some opportunity. I still think broadly speaking, there's probably still some adjustment that needs to be made. We started, the difference between the valuations of growth stocks and the valuations of value stocks started at a historically very wide level. Those have come in, those have started to narrow, but they're not all the way back. So that adjustment period may take some time, broadly speaking, but I think there are good specific values within some of those growth names. You just have to, it's a rifle shot, not a shotgun shot at this point, in that space.
Okay. So people typically get a little bit anxious when the market does what it's done for the last 6 or 7 months. What would be your thoughts on reactionary items or things that people might want to be thinking about as we go through the next 6 months of the year?
Mm-hmm. Yeah, I think it's, these are always difficult times. When you get in the middle of one of these pullbacks, fear sets in, and the natural reaction is, okay, get me out, just alleviate my pain. I want to get rid of the pain, so sell. And sell is kind of your natural reaction. Yeah. I think that's the wrong reaction. I can't tell you that we're at a bottom or maybe even near a bottom. We may, but I do know, one of the things we did, we just put a piece out on this, or going to put a piece out, looking at historical pullbacks. So we've had 38, since 1950, we've had 38 what we call corrections or bear markets. Corrections meaning pullback greater than 10%, a bear market greater than 20. We have 38 of those since 1950. The average drawdown time was 6 months. Some longer, some shorter, but average 6 months. We're almost 5 months into ours. And the average recovery time for almost 60% of those pullbacks was about 3.5 months. And so, we're, whether this is more than average or less than average, it's hard to say. There's still a lot of issues that we're working through. But one of the things we wrote, what I do know with a fact of historical accuracy, 100% of every one of those pullbacks went on to new market highs. So every pullback we've seen since 1950 have eventually gone on to new market highs. So, I would say, and so, so timing the market's very difficult, and so I would say resist the urge to time the market because it's, maybe you get the sell call right. Maybe you got out early, or maybe you're getting in now and there's another 10% to go and you go, hey, great job, me, it feels good. And I alleviated some of my pain. But you got to make two calls right when you do that. You got to get the sell call right and you got to get the buy call right. And getting the buy call right is very difficult. And doing that consistently is very hard to do. So, the buy call requires you to kind of, the perfect time to buy the market, is usually the market still feels bad, right? The headlines are still bad. All the things that brought the market down are still in place. It's just that the market's gotten to a level where it's discounting all that in. But if you're waiting to feel good, when you want to get back in, you're going to wait too long. The market's already going to move on you before that happens.
You already missed it.
Right. So, the right time to buy the market almost never feels like the right time to buy the market because things are still going to be seemingly bleak based on headlines and what's kind of coming out then. So, buying in February of 2009, which was the perfect time to buy the market, if I pulled up a newspaper, from February of 2009, it wouldn't have been a fun read. But that was the perfect time to buy the market. I mean, you couldn't have picked a better time, but it didn't feel like it then. So I would say,
or March of 20.
Right. I mean, pick your low. It's never going to feel good. So trying to wait till it feels good, you're too late. So I would say just avoid trying to time the market. And then two, as you know, we tell people look for money that's put in equities, right? We have a long-term time horizon, and we say 10 years. And the reason we say that is, we want the odds to stack in our favor, right? And so we went back and looked at 100 years of stock market data, and we said, okay, let's pull out every rolling return period over the past 100 years. So 1-year returns, 5-year rolling returns, 10-year rolling returns. And what we found is, on a daily basis, it's no better than a coin flip if you're getting a positive return, right? Market might be up, market might be down, it's a coin flip. But as you expand out your holding period, your odds of success grow and grow and grow exponentially. So at a 10-year holding period, you have about a 95% chance of generating a positive return. And if you strip out, a lot of those negative outcomes were from the Great Depression. So if you strip out the Great Depression, that percentage goes to 98%. So, for most 10-year holding periods, you had a 98% chance of making money in the market. I like those odds. So you got to kind of, I tell people when they, are worried about the market, say, I don't want you to pull up any 6-month charts or 1-month charts. I want you to pull up 10-year plus charts, right? So that's the time frame we need to be looking at, because if you pull up those short-term charts, it gets scary, it looks bad. Hey, I've lost a lot of money, but you got to zoom out a little bit to know you're in this for the long term. The U.S. economy is not collapsing. Companies are going to find a way. It may be an adjustment period, but capitalism is not dead. Companies are going to strive for profits. There's going to be new companies and innovations, and all those things are not, going to stop. And so that's ultimately what you're investing in, right? At the end of the day, you're investing in the dynamic capitalism of U.S. economy or other economies.
Okay. That's good detail. I like that. Bri, what have we not peppered Jonathan with thus far?
I think the only thing on our to-do list is kind of the Ukraine-Russia situation that we haven't really touched on yet.
Yeah. Save that for the end.
There you go. I will preface it by saying I'm not a geopolitical expert, but I will say, what that whole conflict did, the impact it's having in the markets is, it really poured some gasoline on an already kind of smoldering fire of inflation, right? And so you already had oil kind of rising, some of these commodities, and then this conflict starts, and you got Russia, which is 20% of the world's oil production, basically come off the market, or at least off the Western world's market, and so and then there's other commodities that they kind of control as well. So Ukraine is a big wheat producer. So the economic, impact, really kind of, like I said, kind of added fuel to the fire. I think one thing that's surprised everyone, me included, and I have a lot of invested interest with a daughter who's from Ukraine, is, everyone expected this war to be over in 3 days. Oh, Russia's going to invade, they're going to roll right over them, and 3 or 4 days later, we'll have some kind of, Russians will take Kyiv. Well, now we're 3 months or more in.
Yeah.
And it's proven a much tougher challenge than thought. So I don't know what the end game is. Like I said, I'm not a geopolitical expert. I will say, it's probably some of the best analysis. Maybe it ends up being kind of a split country with some Ukrainian and Russian controlled areas. I don't know. So it is something to watch. And Putin's kind of an unpredictable character, so we don't know what his ultimate end game is. But I think markets do adjust. We've had conflicts before throughout the world. You can look at a long-term history of stock market chart and point to Iraqi invasion, and there's a myriad of conflicts that happen, and they're scary. And humanitarian wise, they're terrible. But we got to kind of detach that a little bit from the economic impact. At the end of the day, Ukraine is not a big contributor to the global economy. They're still a relatively small, poor country. Russia is in terms of some of the commodities, so that's really where the impact's being felt. But I think that's being, none of it is new news to the market, right? And the only thing that would potentially make things worse is something very irrational from Putin. But we'll see what happens. I don't know. But I think there's probably more potential for upside to where expectations are. Right now, people are expecting kind of the worst, right? This is going to draw out. Russia could do something unpredictable. There's fear in the market. What people aren't discounting in the market is, okay, what if something good happens? I think you would see a significant bounce in the market, if that were to happen.
Do you think that the sanctions that were placed initially from an economic impact, do you think they've accomplished what they were trying to accomplish, or do you think that maybe they haven't?
I think yes and no. I think what they've done is completely isolate Russia from the world economic system. Right now, they've got a life support because oil's at $110. So they've got a life support system, but that can't last forever, right? And whether a slowdown in the economy brings oil down to back to something less than 110, that will hurt them. And without that cover of oil prices and gas prices, and that right now they've still got the leverage of gas flowing into Europe, but that may not be permanent. So yeah, I think it's made them a global pariah in the financial system. That's going to take years and years, if ever they recover in terms of being able to plug back into the world economic system. So I think it's been effective in that sense. But right now, they're able to kind of survive, so to speak, because energy prices are still fairly high.
Okay.
So overall, if you had to give one piece of advice in the current market, what would it be? Other than just remain calm, going to be all right.
Yeah, I think I've kind of touched on it through the podcast, but I think stay focused on the long term. Don't try to time the market. I tell people, I said, we're not the only ones who preach not timing the market, right? There's lots of very large firms, that manage lots of money, and they all preach not timing the market. There's a reason for that, because the firms that try to time the market don't exist anymore, because it's very hard to do. And some firms may try to do it, and they may have some success, and then it blows up in their face. And so there's very few firms that exist in existence today that have done it well and will come out and say, yeah, time the market. So there's a reason that's a truism in the market, because it's true. So I would say just, stay calm, stay focused, stay focused on what that pool, if we're invested right, based on the plan that we've put in place, we've, partitioned them, you've got short-term stuff that we've kind of kept out of risk, or in lower risk buckets for some things that you're going to need in the next 1, 2, 3 years. the money you have over here in the market is not stuff you're going to need for 1, 2, or 3 years. If you don't need it for 10 plus years, I go back to the analysis before, you have very high odds of getting a good return on that money over the long term. So kind of put that in your mind as that's what that money is for.
I want to comment a little bit on that. So from the seat that I sit in on a daily basis, from a planner's perspective, I think the one thing that we come back to is how important the planning actually is when we put it in place when people are not emotional and when things are not going haywire. So I think that's one thing we'll always come back to, and people kind of get tired of hearing it of, look, these are the goals that you told us were important. This is what you are saying you want to do. If nothing's changed, well, we're emotional now. Emotion typically makes us make bad decisions. So if you can remove the emotion, which is really easier said than done, especially when the market's bouncing around like crazy and the news is telling you that, the sky's falling, I think that's the win, right? So shameless plug, but that's why we do what we do.
Right. Yeah, I mean, Morningstar does that analysis where they say, they look at the average, market return has been X, and then they say, what are the actual client returns? We know what the market's done, but that's assuming you stayed invested. The actual client returns, when they look at actual behavior, it's less than half, maybe a third of that return because of what you just said. They want to get all in when things feel good, and you want to sell when things feel bad, and that's the exact wrong thing to be doing.
Nobody ever calls when the market's up 30% and wants to sell. Right. They don't do that.
No. They want to double down.
Oh,
right?
Yeah. Put more in.
So part of it, and you're right. So you're exactly right. Part of our job is to try to reverse that psychology a little bit and keep people focused on the long term, and be thinking, maybe I shouldn't be thinking about selling now. Maybe I should be thinking about buying now. This is a great opportunity.
There you go.
We're not going to time. I don't know if today is the low or next week's the low or even a month from now is the low, but I do know we're getting better prices than we were 6 months ago.
We know it's 20% on sale.
Right. I mean, stocks are we've heard this before. Stocks are the only thing that people don't like to buy on sale. Yeah. If it's a car, if it's clothes, or 20% sale, give me, let me in. But stocks, no. I'll buy it when it's at full price.
Interesting?
Yeah.
Okay. Well, I think we've hit on all the points that we had lined up. Is there anything else that you can think of that we need to cover?
No, I think we're good. Yeah.
Okay. Thanks for spending some time with us. Jonathan, I appreciate you taking time out of the busy day. I know the market's getting ready to open, so you probably want to see what's going on. If you have suggestions or topics or questions that you'd like for us to cover on future episodes, you can email us directly through our website at fostervictor.com, or you can follow us on Instagram at Foster Victor Wealth Advisors.
And on our Instagram every Wednesday, we do a weekly market update with Jonathan. So if you like what you saw in this episode, make sure to check every Wednesday.
Cool. Thanks for spending time with us. Share it with a friend. Subscribe. Have a great day. Information contained in this podcast was intended for general use, not to be used as specific advice. For content tailored to your personal situation, please contact one of our wealth coaches.